Since the war in West Asia broke out on 28 February, Indian markets have taken a serious hit. The Sensex has fallen by over 6,700 points, about 8% down. The Nifty has dropped more than 2,000 points. Now this has unnerved investors, with many panicking and selling stocks. But what if this panic is exactly what long-term investors should avoid? Because history shows something very different, and precisely why experts are advising this may not be the time to exit, but to stay invested. Why? Let's understand in this episode of Market Special. In February, 65.72 lakh new SIPs were opened, but 49.7 lakh were discontinued or matured. Now that's a stoppage ratio of 76%, implying nearly 3 SIPs stopped for every new one started. This is panic selling, and analysts say this is exactly where retail investors go wrong. Markets do fall, but they don't stay down, and we have sufficient historical data to back this. After the 9/11 attacks, markets fell 6 to 7%, but bounced back strongly, rising 14% over the next few months. After the Iraq War in 2003, markets dropped 7 to 8%, then rallied 15 to 16% in the subsequent year. The pattern is the same every time: shock, fall, recovery, growth, and SIPs are built precisely for this cycle. When markets fall, your SIP buys more units at lower prices. Your average cost comes down. When markets recover, those extra units deliver. This is called rupee cost averaging, and it rewards patience, not panic. Now, if you're continuing or starting SIPs, where should you invest? Across the board, wealth managers are pointing to two categories: multi-cap funds and flexi-cap funds. These invest across large, mid, and small cap companies, offering diversification, and they give fund managers the flexibility to shift allocations as the market evolves. In volatile markets, that flexibility is an asset. Experts say that large cap and flexi cap funds should form the core, with small cap exposure added gradually via SIPs. Among sectors analysts are watching: financial services, capital expenditure, manufacturing, and domestic consumption. These themes, they say, retain long-term structural strength. So, overall, experts suggest avoiding fear-driven decisions and staying the course. Investors who stayed invested through 2001, 2003, 2008 and 2020 came out ahead. The ones who stopped were locked in their losses and missed the recovery entirely. Nobody knows when geopolitical events will end, but we do know that over the long term, Indian equity returns have been in the range of 12 to 15%. That's all for this episode of Market Special. We'll be back next week with more such deep dives on markets and the economy.